Exciting news last week. We saw the biggest drop in the bond yields since COVID. Now, the big question is, why is this happening? And to be honest with you, the answer might not be what you're expecting. My name is Miles Noack of the Noack Mortgage Team, powered by Indy Mortgage. And today we're going to take a dive into these bond yield drops, what it's going to do to fixed rates, and what we can expect in the future. But before we jump into this, make sure to do me that huge favor. Hit the subscribe button, hit the like button if you find content like this interesting, and to help me get this content out to more people like you. Now, let's get into it. So, why are bond yields dropping and why should you care? The main reason you should care is because the bond yields have a very large effect on our fixed rate mortgages, whether it's a 5-year or 3-year or 4-year fixed rate mortgage you're attaining. These are going to have a direct effect on that. On top of that, we saw the biggest drop in the bond yields that we've seen since COVID. Now, a lot of people are thinking that these drops are based on the recent cuts from the Bank of Canada, which, yes, that kind of had an effect, but believe it or not, the thing that had a larger effect on this was the actual job market data coming out of the United States. This job data indicates that the United States could be slipping into a bit of a recession, which is going to give room for rates to decrease further. So even though we just saw a large drop, there could be more on the horizon. Here's a quick breakdown of everything that's going on. The recent report out of the United States in regards to their job market showed a weaker than expected job market, which could signal the signs of recession, which also gives room for the Federal Reserve to start cutting rates. And as the Feds cut rates, it's going to give more room for the Bank of Canada to lower rates as well. As a result from this jobs data, we've also seen this large decrease in the bond market. As a result, our bond yields, which dictate our fixed mortgage rates here in Canada, have also declined quite aggressively. And, when we look at this means there's a good chance that they could continue going downward so long as we continue seeing this downward trend. For example, if we take a look at the recent data on the 5-year bond yield, for example, as it decreases, that gives opportunity for lenders to give lower 5-year fixed rate mortgages. Now, a lot of people have been opting in for shorter term products, a 3-year mortgage or a 2-year mortgage. As rates come down on the variable side of things, that's becoming a conversation, but I still think they're a fair bit higher than what we want to see before, I'd advise someone to take a variable. But this does put us in that position where we're starting to see this downward trend in rates. And it puts us in a position where anyone with a mortgage coming up for renewal is really going to want to pay attention to this stuff, because as rates come down, you're going to want to look at this and say, okay, does it make sense for me to take that short term, that 3-year fixed? Or is it time I take a 5-year fixed because rates are, at a decent area? Or maybe it puts me in a position where I can start considering that 5-year variable so long as it has good lock-in opportunities for protection, and as long as it's going to have our payment float down with the interest rates or stay stagnant depending on your goals, whether it's to pay your mortgage off faster or to have your payment go down. It just puts us in a spot where there's going to be more options, which is fantastic because for a very long time, we've been very limited with mortgage options. If you wanted to have access to lower rates sooner, take a 3-year fixed. If you were scared rates were going to go up, take a 5-year fixed. Variable, forget about it. No one was taking those. So it puts us in a spot where we have options. And as a mortgage broker, that makes me so happy because I'm not a banker. I don't just sell one lender's product. I have access to a ton of lenders with a ton of different products. And I love showing different opportunities for customers because it allows the customer to see these options and pick the one that works best for them. So as rates go down, I wanted to give a quick example of, what it would look like for you. So let's say you're sitting there and you've got a mortgage coming up for renewal and you've got a $400,000 mortgage. If rates are to go down by 0.5 point, that could spell out roughly $10,000 in interest savings over a 25-year period. And it's not just the short-term and immediate savings that are beneficial, it's the long-term savings that you want to look at as well, or the potential to create even more long-term savings on that interest. What I'm talking about here is actually taking advantage of the lower rates and maintaining that higher payment, allowing you to allocate more funds towards the principal of your mortgage, allowing you to pay it down faster, allowing you to save more in interest, and all the other good things. For example, if we take a mortgage and we can save you 5 years off your amortization, so let's say we start at 30 and then you pay it off in 25 years, the amount you're going to save over those 5 years that you didn't have to pay interest is going to be massive and hugely substantial. It's definitely something you want to consider when looking at lower interest rates. Is if you can afford the higher payment, sometimes it might make sense to keep that higher payment and pay the thing off faster. So to sum this up, this recent drop in the bond yield based on the weaker job data out of the United States is a really good thing, even though it's on weaker job data. I really hate the fact that we look at it and talk about, weaker job growth and unemployment and stuff, and almost have it with a positive light because it means interest rates go down. But it's going to allow us to get to a position where we can drop these interest rates, making homes more affordable. Hopefully it's going to push things like rent down, home prices. I don't know what it's going to do there, but it is a step in the right direction, and it's going to decrease these interest costs and make it easier for would-be homebuyers, such as first-time homebuyers who are struggling so much right now based on the fact they've got these high inflated purchase prices, and then they've got these high interest rates on top that you have to qualify at contract plus 2%. So let's say we've got an interest rate of 4.89, you're qualifying at 7.89%. It makes it really difficult. So this is a very welcome change to see if these rates go down, allowing more flexibility and opportunity for first-time home buyers or people looking to sell their first house to upgrade to the bigger home to have their family and more room for kids to run around and stuff like that. So like I said, it's a step in the right direction. It's good and bad news all at the same time. Now, question for you. What do you think this data means? Do you think rates are going to continue going down, or do you think we could potentially see them increase? Drop your comments down below, and as mentioned before, if you got value out of this video, please consider liking and subscribing. Thank you so much for tuning in. We'll catch you next time.